Just started. Hi, Stefan.
Hi, Fagan. How are you?
Hi, welcome everybody. Good evening, first of all, and thanks a lot for taking out the time to attend the Hangout today. Let me introduce myself for people who have not already met me at one of the upGrad events or have not talked to on the phone call. I'm Falgun, and I'm one of the co-founders of upGrad. And it's been great interacting with all of you across the various channels that we have, be it offline events, be it on the various calls that I've had with you. And it's great to have you for this session again, as I had mentioned. So I'll be the moderator for this session today. And let me quickly run you through the agenda. We have Stefan with us, who is born German, and he works with Bertelsmann Media Investments. He's worked with Bertelsmann Digital Media Investments in Berlin for 3 years, after which he's moved to India, and he's currently working with Bertelsmann India Investments in Delhi. And he's also worked on various investments that Bertelsmann has made in Pepperfry, Saban, India Properties, and others. So essentially, the agenda for today is that Stefan will walk through a presentation explaining the VC funding situation and the landscape in India for the first 20-25 minutes. And in the meanwhile, what you should also keep doing is there's a chat window on the right, and please keep posting your questions, and we are consolidating this. We might not be able to answer all of them given the limited time that we have, but we will try to do our best in terms of answering all the questions. So please keep posting your questions and we'll consolidate them, and Stefan will answer them at the end of his presentation on the VC landscape in India currently. So again, welcome, and now I'll start off. Welcome, Stefan, to the session, and over to you now.
Thanks again, Fagan. So welcome from my side also, and thanks again, Fagan and upGrad team, for having me here. I'm really excited to be here. As he mentioned, I've been in India for almost 3 years now, and so have witnessed a really exciting time over here. So today, as he said, I'm going to be speaking about venture capital, what it is, how it works, and a couple of the developments in the country that have been going on for the last years. And yeah, so let me actually start off. I'm going to share my screen right now. Hold on. Are you guys able to see my screen? Hi, good?
Yeah, we can see your screen.
Oh. So I'm going to be starting off with a couple of quotes that I put together from various news sources, mainly outlining that 2015 has been a really, really great year for the Indian startup ecosystem. Just touching a point of view, there have been 3 new, for lack of a better word, unicorns or billion-dollar companies that entered this year. Paytm, or quicker. Then Alibaba has entered the country, investing into Snapdeal. Really exciting also to see that. Will be also quite interesting to see going forward how that battle of these now 3 e-commerce giants in India will pan out. Then the venture capital funding has hit a new high over the last years. I think this year purely venture capital funding was around 7.2 billion so far, almost doubled from last year. Then I've outlined also one news on our portfolio company, Pepperfry, raising funds from Goldman Sachs, which also is a very exciting development. For Goldman Sachs, this was the first internet startup investment here in India. Then you can see a couple of logos there as well. Very exciting also to see, a couple of good exits happening in the country. Taxi for Sure getting acquired by Ola, FreeCharge getting acquired by Snapdeal. And last but not least, I've put in a quote over here that will also serve as a bridge to my presentation now. By LiveMint, over the last 10 years, venture capitalists have played a central role in shaping India's startup ecosystem and ushering in a decade of innovation and disruption. And I just wanted to speak about how it works, what it is, and why it is that venture capitalists fuel that growth that has been going on over the last years in the startup ecosystem. So basically, the situation that every entrepreneur is in is how do you fund your business? I mean, nothing comes for free, right? So the growth phase has to be funded. You will have initial losses also. So essentially, you have two ways. Either you take a loan from banks, and the riskier your business is, the more unlikely this option gets. I'm going to be focusing, as I said, on the right part of the slide, on the equity financing. There are various options. First of all, you can put in your own money. You can use family and friends' money. Some people also call this the 3Fs, family, friends, and fools. Then there are various business angels, seed funds, and accelerator programs, which especially help for the initial phase of the business. And then obviously typical VC or PE funds focusing on Series A, Series B stage of businesses, helping also a lot in the development of the company. So now moving on to the next slide, and I want to spend a little bit of time over here. I've bucketed that in 4 phases: launch phase, the early phase, the growth stage, and later stages. And I'm going to be focusing purely on the first 2, as this is as these are the relevant ones for you also as startup entrepreneurs. Let me start with a couple of characteristics of those. The characteristics of the launch phase obviously would be R&D, spending time on developing the first prototype of your product. Whereas in the early stage of the business, there has been some sort of proof of concept. Some first revenue has probably come in, and the money for both phases has definitely also different use cases. For example, in a launch phase, you would be needing money for developing this product, for hiring a few people. Whereas in the early stage of the business, while all of these remain the same, you would want to scale up the business. You would want to spend up more in marketing and sales, for example. And the more right you go on this graph, the less risk you can say it gets. So obviously the failure rate in the very initial days is very high, and even in the early stage, in the growth stage phase, there's still a high risk involved. But yeah, as your company grows, as your company develops a more dominant market position, the less riskier it gets for investors and for yourself. Now, a couple of those equity options that I mentioned in the previous slide, just wanted to lay out where those guys would fit in here. So the business angels will obviously be in the launch phase. Typical ticket size over here would be, it depends, but it would be around $50,000 approximately. Then I've also put in a few logos over here of various or select seed funds in the country, in India: Bloom Ventures, K Capital, India Quotient, 500 Startups, and GSF. The typical investment size would be between 100,000 and 300,000. The advantages of this capital over here is that the process of raising those funds is very lean, and it doesn't take very long. And generally, also there's a very fast decision making involved with those people as partners. Also, business angels themselves have been, usually serial entrepreneurs or entrepreneurs themselves in the past, successful, sold a business probably, and can handhold you as an entrepreneur a lot while you're going through similar phases. And then moving on to the early stage of the business, this is where a lot of prominent names that probably most of you are very familiar with fit in. Series A, Series B, venture capital funding. The names like Tiger, Norvest Partners, or Helion, or even ourselves. So the couple of characteristics points that I wanted to mention over here are all of these are able to also write bigger checks. So going forward, as you have partnered with venture capital funds like these, they will continue to support you. And the process usually takes a little bit longer, 1 to 3 months for the fundraising to be finalized. However, there's a very, very strong value add that these people will bring on board. Again, most of them are entrepreneurs themselves or have been entrepreneurs in the past, so they know exactly what you're going through. They will provide portfolio support on marketing, on product, on technology. And I think there's a very, very strong, synergy that comes in over here. Just touching upon a few exit types for the venture capital fund. These are the four main ones. You can go public as a business. Your company can get sold, as I mentioned in the very first slide, for example, free charge. And there can be a secondary sale, for example, you selling a stake to another investor. And also a buyback can also happen. So moving on to the next slide, I wanted to lay out basically how does venture capital work. And this is a very simplified process chart over here. So basically there are three parties involved, simplified. There are the limited partners. These are the guys who give money. This could be large pension funds, large corporations, insurance companies, and they just want to diversify their portfolio and put in a little bit of their money into a risky option. So the venture capital fund raises a fund by people like these, and that becomes the so-called fund size, the fund that a VC is managing. The lifetime of such a fund is usually 8 to 10 years, whereas the initial years are spent on investing. Then there's a management phase, which is always going on. Portfolio management will always happen. And the last years of the fund is usually about exiting these businesses in order to ensure that you can pay back the money with returns to the limited partners. How does the venture capital fund earn money? There's a management fee involved, usually around 2 to 2.5% per year on the assets under management. And also there's a performance-based fee, which is called carried interest or carry. So now that the venture capital fund has money, it will go through a diligent process of finding the right startups to invest in. And I'm going to touch upon that more in the next 2 slides. Just quickly mentioning a key point over here. Once the fund life comes to an end, the venture capital fund will exit the business. And usually what is happening over here is that there are very few portfolio investments of the VC who will give back the most chunk of the return. So just quickly running through an example, if you invest $100 million in 10 companies, usually out of those 10, the returns will come from 20%, meaning 2 companies of those. So a minimum good rate of return would be around 20% per year. That would mean you have to pay back around 6 times what you've paid in to the limited partners, which means those 2 companies that that do not fail, they really have to be extraordinarily good in order to pay back such a good and high return to the limited partners. Yeah, that's about it. So let me move on to the next slide and tell you guys a little bit more of how venture capital funds evaluate businesses and how do they end up making investments. So we bucket this in various phases. The first phase would be contact stage. This is where deal sourcing comes in. How do VCs source their deals? How do they get to the startups they want to invest in? So there are many ways actually, but obviously a lot happens through contacts. Then there's a market screening involved. So if a VC has figured out, okay, this is a market segment that is really of interest to us, we really like it, then you can safely assume that every single company out there in the market would be known to this particular investor. And and then there are first meetings and discussions. And the next phase we call limited review. Usually around 2 to 3 weeks of very diligent analysis, basically our own homework on the market, on various things, on strategy, on the team, on the execution. Basically, at the end of this phase, you should be able to make a decision: do you want to invest in the business or not? And if the answer to that question is yes, the next phase would be the term sheet phase. A term sheet is basically just a broad agreement on the deal, on various key rights. It's a non-binding agreement, but the understanding is basically agreed upon in this document what the deal construct will be, and this includes, for example, the valuation of the company and various other key rights that the investor will get, board seats, and so on and so forth. So once this is done, there are a couple of outstanding points left. For example, remaining due diligences like legal due diligence, where all the contracts and agreements that are in place in the company are getting checked. Financial and tax due diligence, other diligences like technology. Basically, everything is finally screened, partly also through external vendors that are being hired by the VC firm to make sure that everything is in order. And at the end of this phase, it comes to the final negotiations. The legal documents are being closed, and then finally the signing happens and the money is being wired. And after that, this particular company would then be the portfolio company of that venture capital fund. In the background, also there's also various approval processes going on with the investment committee of that particular fund. The investment committee basically consists of members of the guys who give the money. So now, within that point 2, within limited review, what exactly is it that venture capitalists value and evaluate? I've outlined a few over here, and this is a construct that we follow over here, and I think this probably holds true to every single VC out there. So there are essentially 5 points that we look at. And the first one is the market opportunity. This includes the value proposition, the product market fit, the size and the growth of this particular market segment. Then structural things also, for example, regulations that might influence the decision. Then obviously also, last but not least, competition. Also very, very strong point over here that is being looked at. And the next 3 outlined over here, team, product, and strategy, are what I would call the execution part of the business. If you look at team, mainly what we look at is how are the execution capabilities of this team? Was the prior work experience relevant? How is the alignment of mindsets between the investor and the team? What's the drive behind the team? How complete is it? So team is a very, very critical factor. And I think you'll hear that also from many people. Team is probably the single most important part of our business. Moving on to the next one, the product. Obviously, is your product disruptive? How good is your idea? How defendable is it? What kind of traction has your product seen? How successful has it been? And so on. And the strategy part is mostly about what is the vision? Is there alignment between the thinking in terms of how and where to get in the next phase with the money that you're investing? Looking at these 3, team, product, and strategy, I would club them together in one point: execution. And market opportunity would be another important point. If I leave the last one, deal, aside for a second, if you look at market opportunity as well as the execution part, meaning team, product, and strategy, the very, very large returns that venture capitalists get will be from businesses where both these points are very strong. So businesses with returns for the investors of many fold of the initial cost, there would be a very strong execution and a very large market opportunity. Let's assume the market opportunity is very niche. If the execution is still great, you will still be able to succeed within your business. It might not give you a 100x of initial investment, but still it will still not be a failure. Now, if both market opportunity as well as the execution part are not good, then this would probably be a failure. Then the last point that I've left aside before deal is also something that obviously will come into consideration for any VC fund that is looking at a company. How attractive is the deal? What kind of valuation is it? How much stake will you get? How much influence will you have in the company? What are the rights, and also what is the exit potential of this company? So moving on to the next part, and that brings me to the next section of my presentation. What are the recent key developments in startup funding in India? So I bucketed this following slide in 3 parts. This is basically describing the last 15 years of venture capital in a nutshell. You can see a timeline over here. There are a couple of key developments that I can walk through, and I also put in a few logos in order to give some context of what has happened at what time approximately. After the dot-com bust in mainly US, but globally, there was it was a very difficult time for tech startups. There were 2 Indian startups that survived and even back then gave good exits. There was Bazi.com, which was sold to eBay for $50 million, and there was JobsAhead.com, which was sold to Monster, for $10 million. Then in 2006, this was not necessarily an exit year, InfoEdge, but I still put it there to give some context. InfoEdge went public. Also at the same time, there was another generation of Indian VC funds coming in. This will be the likes of Helion, Nexus, or IDG. And also a couple of Silicon Valley VCs have started making direct investments in India. In 2010, Make My Trip went public. In 2013, Redbus was sold to Naspers. Chasdial went public. Flipkart was the first of the internet startups in India to become a billion-dollar company. So I think in 2013, this was also my first year in India, by the way, and you could clearly see that things are starting to happen. What was the key trigger over here was that there was some sort of realization that the inflection point that everyone kept talking about in terms of internet users, we will reach that inflection point and so on and so forth. The realization kicked in that this inflection point has been reached now. And also in the following year, in 2014, more foreign investors also came in, the likes of SoftBank or StatView or Alibaba, as I mentioned before. And valuations then started rising. This was also a function of the global situation. Post 2008, the Fed rate was since 2008 actually, the Fed rate has been close to 0. That was to stimulate investments. And specific investors, they were still looking for returns and were moving more towards chasing private companies. And new asset classes were explored, and this entire situation trickled down to startups in venture capital funding, and the valuations therefore resulted in much higher valuations being paid. Yeah, and that was sort of the starting point of what happened over the last 1 or 2 years. And on the next slide, I'm going to speak a little bit more about that. Just mentioning a few companies which have been milestones over the last 1-2 years. There was Ola and Snapdeal and InMobi, which received billion-dollar valuations for the first time in 2014. Myntra was sold in Flipkart to Flipkart. And in 2015, as I mentioned before, FreeCharge and Taxi for Sure gave notable exits, and Quikr, Paytm, and Zomato also entered the billion-dollar club. So I think over the last 2-3 years, a lot of really exciting things have been happening. That also created a little bit of fear in the market, especially over the last 6 months, because in the first months of this year, first 6 months, or even the ending of the last year, there was a situation observable which was very exciting for entrepreneurs and so on, but also at the same time a little bit scary. There was a valuation shift that started happening. Suddenly, valuations that were usually being paid in Series B rounds were suddenly there in Series A. The deal closures were really, really fast. Within 1 or 1.5 months, something was basically, an investment was done. And also the time between the fundraisers has decreased significantly. Sometimes companies would raise funding and then within 6 months would raise the next round. And that also allowed a little bit for mistakes to gain some dominant market position. If you have more money available, you can experiment a little bit more, and so on and so forth. So it was quite an exciting but scary time, and it's still sort of like that. The only difference now is that the realization has sort of kicked in that the market is a little bit overheated, and therefore the valuations have been rationalizing over the last months, going down by 20 to 30%, I would say. Then an interesting development also is that the status quo of the large players, incumbents, are also being challenged by certain new companies which have built great products, also disrupting partly incumbents in their core business. An example would be in the food tech space. If I look at Zomato, which is still doing a really great job, and I personally love it, and has been one of the great product companies here in India. But then, if you look at the development over the last 1 or 2 years, there have been companies like Tiny Owl or Swiggy, which have come in and are now challenging certain parts of that status quo of a business like Zomato. And there are many other examples also like that. And obviously, there have been also a little bit not so good news, all the layoff news recently. But yeah, that's just a function of all of this that started happening. What that means for you as entrepreneurs, as startups, it's actually that not much has changed for you. You still have to build something valuable. You still have to focus on building the best product out there in the market. Investors which are in the country, they will still be on the lookout for the best opportunities and the best companies to partner with. And a lot of these funds, the venture capital funds, they are anyway sitting on a lot of money that they've raised, and they will focus on finding the best assets in the market, and they will also reserve money for their portfolio companies. So I think for you as entrepreneurs, long story short, you should just focus on what you can do best, building the product in the right manner, and if you do that, I think there's nothing that has changed during the last months. And I think that's about it. Happy to answer any further questions that you might have on the topic and so on. So I'm gonna stop sharing the screen. Hold on.
Perfect. Thanks a lot, Stefan. It was a very informative and a brilliant presentation explaining the audience, the various types of investors and the ticket sizes generally that they invest, and also what are the various factors that they consider before investing. I think also the VC landscape on the current VC ecosystem and the landscape was very articulate. So I think thanks a lot for the presentation. It was very useful, and we already have a lot of questions coming in. Please keep typing in your questions on the right, and we will answer as many as possible. And to start, the first question that we have is from Faninder, and he's actually asked 2 questions, but I'll club them. So what Faninder is asking, Stefan, is how do we value a startup company which is just started and only has a few proven revenue streams? How do you value such a company which has only a few proven revenue streams and it has just started?
Yeah, so there are many things, and I touched upon it a little bit. So first point is the market situation. So is the market large enough for a company to grow into? The second point is the team. The team execution skills really need to be great in order for any investor to show interest. And that is a function also of management skills and what kind of talent have you attracted, and what have you been able to build with the limited money you had. So that I think plays a very key role also. And the product prototype, even if it's limited, even if there's zero revenue, it still tells a story. There's so many companies also that we see that are probably pre-revenue sometimes, which are still great opportunities to invest in because of the potential it can have, and that's the key point I think you can look at over here.
Perfect. I think that makes sense. And the second question we have is from Anup, and it is something related to what you were just describing earlier, is that if you're an early stage startup and you're starting out with an idea and a prototype, who is the ideal investor type for you? Do you reach out to angel investors or VC firms? And I think just to restructure the question a little better, because there are multiple questions on this theme, is you explain the various investors, angel, VC, X, Y, and Z. So what are when you're reaching out as an entrepreneur, at what stage do you reach out to which kind of investor? If you can discuss that in a little detail, I think that would be very helpful.
I think, in the beginning, first of all, there's no necessity to reach out to any investor. If you can manage it on your own, then that would also be a great thing. But if you feel that there's value in it, and then I think in the initial phase, especially the business angels are a great help, especially because there's fast decision making. These guys know exactly what they're talking about. Most of them have been really successful in their own past career. Then there are so many good business angels also in the country, like Rajan Anandan, for example, is very active. For example, Anupam Mittal from Shadi is very active. Then even Ronnie Screwbala is very active as a business angel also. So I believe you can really gain some really great experience from these guys, as they've gone through a similar thing than you. So I think that would be the first starting point, and then you don't even need to worry about addressing the next phases, the next set of investors, because if you have gotten someone great on board, then it will also give you a lot of network. I mean, these people are very connected. They will make you meet someone and so on. So I think you don't need to worry about who to address at which point. I think you just need to be a little active in the startup scene. But even if that's not the case, if you're building the right product, you can safely assume that you'll be on the radar of many people. So I think that's probably a key takeaway here.
Makes sense. So the next question, Stefan, is from Pushpak. And what he essentially is asking is, what kind of paperwork must an entrepreneur do before approaching an investor? Especially, what are the administrative and legal prerequisites that he has to take care of before reaching out for investment?
Well, I mean, not much, to be honest. It depends a lot on the stage also. I mean, the earlier your business is, the less it is assumed that you have all the proper systems and stuff in place. But obviously, I mean, you should have a proper company in place. I mean, the legal entity should be set up and stuff. And apart from that, I think not much to worry about over here. If I understood the question correctly.
Got it. No, I think that's fair. The next question, there are two people asking a similar question, Aditya and Romil. And what they're asking is, what do venture capitalists look at, or what is the most important thing that they look at when they're investing in startups? Is it the team? Is it the traction? Or is it something else? We have multiple factors that you mentioned, but what is the most important thing that they evaluate?
Very, very clear answer. It's the team. As I said, the team is therefore so important because the entire execution of your business depends on the team. If your team is not great, the idea can be, I don't know how great the idea can be, but you will still not succeed. So the idea, I would rate the idea slightly less than a team. Both have to be in place, of course, but the team is definitely a very, very critical factor to a successful business. And as I pointed out, I mean, if you look at, let's look at the market, look at the execution. If both are great, you will be a great success. If the team is still great and the market opportunity might be slightly niche, then the outcome of your business might not be as great as the previous example. However, it will still be a success story. I can assure you that. So yeah, clear answer. Team is the single most important thing.
Got it. So the next question is from Priyapatra, and it's two different questions. The first one is, should a founder apply to a funding house or an investor who has funded in the same kind of business before? And the second question is, what exactly is the launch phase condition for a startup? So as an entrepreneur, what are the key parameters that they must evaluate before accepting any funding?
Okay, so to address the first question, well, I mean, it depends a lot on you. In the end, it all boils down if you want to fund your business or not. The general rule is any money is better than no money. And yes, there have been investors out there, and it's a general practice. They invest in competing businesses, correct? But for you as an entrepreneur, I think you have to decide on your own whether you're comfortable with that or not. But if you're sufficiently confident with what you're building, that what you're building is a great product, then I think that should not be a factor to not take the funding. As I said, I think any money is better than no money. And if you're comfortable with the investor, and that depends a lot on the like-mindedness, and if you like the partner that you would be dealing with, if you think that he can add real value, then I think it should not matter whether he has made investments in competing businesses or not. And sorry, what was the second question again?
The second question was, what is the exact launch phase condition for a startup? So what are the key parameters that an entrepreneur should check and evaluate before accepting funding?
Yeah, so I think the single most key parameter is you should be passionate about what you're doing. It should not be like you're sitting there and then think about, oh, what could I do? I want to earn money. I want to create $1 billion company. It should really be something that you're passionate about and that you think you can do really, really well. And a lot of times this happens through past situations. Let's say you've been working for the longest time, and then you figure out, oh, actually, there's something I can do better about that. So that's a situation where a lot of people actually get their ideas from, and I think the idea then is really a great one compared to people who scribble it down on a paper and decide to launch this because they want to build some next Facebook or next $1 billion startup or whatever. So I think that's a critical part, and other parameters that you can look at before you found your startup. I think what definitely helps in this case is building a business plan, because essentially it will not be something that someone will hold you responsible for. Oh, why did this not happen? Why did that not happen? And in this manner, you laid it out. But it will still help you to think through a lot of things that you might have not thought through otherwise. That includes the entire market situation. I think you should really become a market expert on the segment that you're getting into. You should be able to answer every single question around the market. Where is it going? How is it developed in the US, in China, in any other country? What are the benchmark companies that are doing similar things? What is the competition like? How have other people tackled it? How can you solve the problem better? What are the unique things, the unique selling points that you have in your company that make your business stand out? And if you really clearly think about those, and if you think about the implementation strategy, what steps to take at which point, then I think this is a good start to launch a successful business.
Perfect. It's interesting, Stefan, that you mentioned a business plan, because we have an associated question on that from Neha, where she is asking, in the early stage, when the future is not very clear or there are a lot of changes that need to happen, what exactly does a business model or a business plan mean, and how detailed should it be?
Yeah. So as I said, I think business plan, no one in 1 or 2 years of your investors or even employees or partners, co-founders will hold you responsible about what you've done in the initial days when you created a business plan. But what it really does, it really helps you think through the entire thing from A to Z. It will make a lot of things clearer. It might even give you a lot of insights about things that you've not even thought about. So that's really a key thing over here. And at the end of the day, it doesn't matter so much whether you thought in year 2 you will reach this number of users or that number of revenue. As long as you closely monitor what is happening and why it is happening, and link it to what your initial suggestion on this was in your own business plan, then I think this will really be of great help to any person.
Got it. And just on that, when it comes to business plan, what are the key things that they should think about? As you said, there are some important factors that they should consider. They might change, but thinking about them is important. So what are the key factors they should think about? Like market size, what are the various cost heads that are involved?
Yeah.
So
speaking about external factors,
to understand.
Yeah. So first of all, about external factors, definitely the market should be, as I said, you should really become a market expert in this field. Think about everything that you can think about. Read a lot, meet a lot of people, see how other people are tackling the same topic. What is your competition doing, basically? Really become the expert in the field. That is the first thing. On your product, at this point of time, you would already have an idea of what is the business that you want to launch. So what really helps is think about various milestones that you want to reach at which point. And I would not go into too much detail because, as you pointed out, also in the initial days, everything can change so quickly. So it doesn't make too much sense to lay out every single bit of the business to great detail. But I would really focus on the key parts of the business, basically the key essentials of your product. What are those 3, 4, 5 points? Focus on those. That could be a milestone. I want to reach 1 million users in a year, or I want to reach 10,000 downloads in 3 months, whatever the number is. See if it makes sense from the market size, see if it is realistically achievable, and see what are the steps for you to get there. That can include hiring people, that can include various other things. But at the end of the day, focus on those 4 or 5 key points. Don't go into too much detail, because that will just waste time and not be of any value.
Perfect. I think that's very helpful. And we have a follow-up question from Romil on what is the most important thing that investors evaluate, and you had mentioned team. So he is asking, when you say team, does it mean only the co-founders or the single founder and the CEO, or does it involve all the employees and the people in the company? So what exactly is the team that investors evaluate?
It depends a lot on the state of the business. The earlier you are, obviously, the less complete is your management team and so on. So in the initial days, it could be only 1 person or even 2 people. But what you really have to look for is how suited is your team for executing what you want to achieve. So definitely in the early days, I think there's no need for every CXO position to be filled. But the key decision makers, they're people who drive the product. At the end of the day, they have to be in place, and they have to showcase that they are capable of doing what they want to achieve. And that could be, I mean, what investors also typically look at is how successful was that person in the past? How has he maybe even founded a company previously that has been very successful? How did he even come up with the idea? Was there some specific need that he saw in his previous experience, and therefore he has really thought through this and so on and so forth? So I think, as I said, it depends. I think in the early stage, whoever is there, the founders, they should definitely be in line with the thinking of the investors also. So this specific mindset that people have, the strategy and the vision that they want to go after, that has to be really in line with the investors, because at the end of the day, the investor will not give you money and then he's saying, okay, I'm going to see you in a couple of years. That's not going to happen. It's going to be a partnership at the end of the day. So for you also as an entrepreneur, I would really encourage you to think whether you would want to partner with with such an investor or not. You might be more comfortable with someone else because he has proven in his past investments that he has really helped that business which is similar to yours, something of that sort. So I think the experience of the investor also matters a lot. But yeah, for investors, the completeness of the team, the alignment of the mindsets, and so on. So these are the key points.
Yeah, that makes sense. And moving on, I think we have two questions, one from Priyanka and the other from Priyabhatra, and I'm putting them together because they're very closely related. What Priyabhatra is asking is, for an early stage startup, how do you decide on valuation? So how do you come up with this number of X $million or whatever that number might be? And the second question that Priyanka has, it's a great question, is once we understand how valuation works, the second thing that Priyanka is asking is if you are following a tried and trusted revenue model which works and which has demonstrated success in the market already, does that decrease the dilution that you go through when you get an investment? And if so, by how much?
Okay, sorry, the second question was again, so basically if you want to do a business which is already being done by someone else in the market, does that in any way affect your valuation?
No, sorry. The second question was if your business is following a tried and tested revenue model. So the revenue model is tried and tested and it works. So does that decrease the dilution when an investor comes in? And if so, by how much?
Got it. Okay, so to address the first question, how does the valuation work for early stage companies? It's a very good question. Essentially, the key point it boils down to is how much stake do you want to give away for how much money? And that could be a very negotiation-based conversation. A lot of times it's linked to certain metrics, especially as in if your company is more mature. Let's say you would be doing a certain amount of revenue or have a certain amount of monthly unique users on your platform, on your app, on your product. There are obviously always companies that you can compare that company with, and you look at, as an investor, you look at what kind of valuations has that company achieved. How is this company different from that company? Does that mean we will give a slightly higher valuation, a slightly lower valuation? But the broad range would be the same. So that's more or less about it. I mean, I can touch upon a couple of technical points also in terms of valuation. There's a concept, and I believe also this will be part of the upGrad course also that you guys will do probably at a later point, I'm assuming. So there's a concept of a pre-money valuation, which is basically the valuation of your company before any investor invests money, and once the money has gone in, that is then the so-called post-money valuation. And any money that's being invested in the company divided by the post-money valuation will give you the stake of the investor that comes in. And as I said, it can be both ways. In general, I think the earlier your business is, the less traction or revenue you can show, and it will mostly be about negotiation. How much stake do you want to give away for how much money, and so on. So, and then as your business grows, it's more or less a little bit about more benchmarking to other companies, what has happened in which sectors and how comparable is that. And again, negotiation plays a big role. But any other deeper analysis, like a DCF valuation kind of a thing, would in most cases for early stage startups not make too much sense. So that was that. And the second question was around the revenue model. If that's tried and tested in your case, how does it affect the valuation? Will that mean that the stake, that the dilution that you as a founder have is less than if the revenue model is not tried and tested? It's a good question. I would say yes. It does affect the valuation, because at the end of the day, any investor is more comfortable in putting money in a company which is less risky. And if there's already proof that your model works, the only thing that you have to convince the investor about is how will you stand out from the other company that is already doing this. If you can do that, I think yes, that could be a good negotiation point about valuation. Definitely, yeah. I hope that answers the question.
Yeah, perfect. And the next question is from Anup, where Anup says that how important is having an exit plan when it comes to talking to investors and getting funded? Because as an early stage entrepreneur, you're thinking of building your business and growing it and not really about how you exit.
Yeah. See, I think for a founder, at that point, at a very early stage point, it's not too important. Definitely, you should have some idea of what is the potential your company can reach and what are the potential exit options. Would it be a really high growth story and you would go for IPO at some point? Or what are the kind of acquirers that your business could attract? You can think through those, but you can also be ensured that the investor would definitely be thinking through those the minute he enters the discussion with you. Because as I described also earlier in the presentation, at the end of the fund life, the investor will have to return the money to the limited partners. So it's not a possibility for the investor to not exit. So definitely the investor, as soon as he starts thinking about investing in your company, he would already have certain things in mind about what is the exit potential of this business. But yes, as you enter these discussions with the investor, it would definitely also benefit yourself and the whole discussion if you have thought through this. You don't need to have a super detailed exit plan available because, as you pointed out, it's just not possible at this early stage of a business. But yeah, you should have some idea of what are the potential acquirers and so on. Yeah.
Perfect. The next question is from Vamsi. It's a great question where he says that how do investors think about investing in a company which is copying what somebody else is already doing? Like in some cases, we see that in e-commerce, people invest in very similar kinds of companies. And in some cases, people say that this already exists and there's no differentiation. So how do investors think about it? And would they invest in a startup that is doing something very similar to what other people are doing in the market?
Yeah, that depends. It's a good question. I know there are a couple of funds who are very heavily funded in those kind of businesses and sometimes even incubate those businesses themselves. Generally, also a little bit related to the question before the last question. If the revenue model is already tested, let's say in the US, and you would be just copying that model over here in India, if the entry barriers for that particular company in the US are large enough, then why not? I mean, every investor is looking for the best opportunities in the country available. And if there's some certain differentiation to the business, there's no reason not to invest in these copycats. But generally, yes, I agree. I mean, it's not the most, the thing that people value the most, just investing in businesses that are copying other innovations. But for example, in India, there are a couple of businesses who have copied models from the US, but still there's such a strong differentiation to how it works in the US, simply because of the nature of the market. Certain segments. Just take the furniture segment. It's so fragmented here in India that there has to be a very strong differentiation of what other people are doing in the US, similar businesses. Otherwise, you just cannot take this exact same business model and copy it in any other location of the world. It will not work. So yeah, investors usually look at those things, and if they feel that a business has a strong value proposition, then there's no reason to not engage just because it's a copied business model.
Got it. The next question is from Priyanka, and she's asking, how does a VC fund know what is the right time to exit a particular investment?
I mean, these opportunities just come up, right? I mean, first of all, as I said, there's a fund life associated to any VC fund. So there would definitely be an exit plan that the investors already think about. And definitely after those years of being invested in a company, the investors would sort of push for an exit at some point. But sometimes, you know, these opportunities come up, and when I say exit, this does not necessarily mean you know, great exit. Sometimes it's even exits that cannot be avoided. Let's say you know, your company is not doing so great, the VC's portfolio company, and then an opportunity comes up where a competitor offers to buy you. So this could even happen after a year, after 2 years. So there's no clear decision point. It's just the you know, the general best strategy would obviously be an IPO or selling your company to a very large other company. And in order to do that, it generally takes time to succeed in that business and to build that business. So it definitely takes a few years. But there's no general point that you can, you know, assume over here. Let's just take the example of a very famous investment in the US in 2005 when Sequoia invested in YouTube. And 1 year later, they sold YouTube to Google for $1 billion. And by the way, I would also encourage everyone to read the investment note, which is out there in the internet. If you just Google for Sequoia Capital, YouTube investment proposal, you can really see in 2005 how Sequoia was, as an investor, thinking about where this really early stage company YouTube at that point can you know, develop into, and you know, how it has turned out. So there's no general rule and general answer to that. It just depends a lot on the individual situation. But if you want to build a successful business, it usually takes a little bit of time, depending on the phase you come in. I mean, if you're a really early stage investor, this can take 8 to 10 years. If you're coming in at a very late stage, it can only take a few years. And even if you're coming in at early stage, it can also only take a few years. There's no such rule.
Got it. We have very little time left, so I'll ask a couple of questions. One is from Kiran, and it's an interesting question. He says, if your business does not have competition, do you consider it as a positive or a negative?
Yeah, it's an interesting question. Yeah, it depends on the market, right? I mean, if there's market for your solution and there's no competition, then it's great. But generally, if there's no competition for what you're doing, then obviously people will ask questions: is there even a market out there? Why are there no other competitors doing the thing? So it depends really on the individual market situation.
Got it. I think that makes sense. And there are a couple of questions on hardware and non-tech businesses, which I will ask. But before that, one final question from Hitesh on if you can spend a couple of minutes giving your thoughts on the pros and cons of a self-funded business versus a VC-funded business in the context of a service, in the context of the services industry.
Got it. So pros and cons, as I said, the pros for getting an investor on board are very clear. First of all, your growth can be much you know, faster. It's definitely accelerated because if the investor believes in you, he will provide you with enough money to grow the business, scale a business to a good point within short time. Something that might, if you fund it yourself, take years, and I'm not even sure if you will ever reach there. You might even fail on the way there. The second point is, besides that money, the investor will also give so much other value add. So, for example, let's say hiring. You really want to hire someone who's running your operations, but you don't know who to approach, how to go about it. Investors really have a strong network of people they know from their past investments, from their networks, and so on. So hiring is a very strong positive for getting an investor. Then, as I said, these people are usually also, they have been investors themselves. So they know exactly what you're going through. They can give you great advice in order for you to not make mistakes or not make probably the same mistakes that they did back then. Or yeah, they've probably seen a lot more in the same market segment than you might think. So the value add that they can bring on board is clearly there. On the other hand, of course, getting investor on board means dilution. So any investor would want a certain stake, and sometimes a meaningful stake in the company in order to partner with you, in order to give you money. No one gives money for free. So that's definitely, I mean, a negative point if you really want to be in full control of your business. I mean, even with getting an investor on board, you will still be in control. You will probably get someone on board as a another board member, and yeah, the negative is as the larger your business grows, the more people might come on board. That means your stake might get diluted so much that you, at the end of the day, don't even have to say so much in your own company. That's a clear negative, I would say. But it's not that all investors they're sort of aligned with their interests, so they're sort of on the same page as you are. So therefore, I think it's a tough question. I think there's no clear answer. You should probably evaluate for yourself if the pros and cons are valuable to you in this situation.
Perfect. I think, sorry, I said Harsh, but this was a question from Hitesh. But I'll move on to the question that Harsh has. And just to set the context for this, the tech industry, the tech businesses, startups have seen a lot of funding. But at the same time, there is a parallel hardware industry, pure manufacturing companies. So there are two questions Anirudh and Harsh asked. For a hardware company or a pure manufacturing company, what is the way forward if they do not have enough capital to invest and are stuck at the prototype stage?
It's a very good question. I honestly speaking, I'm not an expert on the hardware segment at all. But the thing is, see, the investors out there, all the investors that I mentioned before, all these Sequoias of the world, it's not that they focus purely on internet startups or something. They do invest in hardware businesses as well. Take Apple as an example. Apple would have probably never reached where it gotten today if it wouldn't have been for investors like a Sequoia. So there's still enough interest for hardware investments, but what exactly is going on in the hardware segment, I would not be able to comment on that.
I think that's perfect. And Harsh, just talking to you, you've asked how are pure manufacturing companies valued, because it's completely different. And as Stefan is mentioning, probably it is something that we can take in the next discussion where we have somebody from the manufacturing industry. So just the last question, Stefan, is actually two very interesting questions that just came up. So one is, what if somebody is running an e-commerce company for the last 2 years and looking for funds to scale up? What are the most important details that an investor will ask given the current situation in the e-commerce industry? So many companies, so much funding already gone into that particular sector. What will an investor look at right now while investing in the e-commerce industry is what Sharan is asking.
Yeah, so one clear point that you will ask is, how are you different from all the other guys? See, there are right now 3 horizontal e-commerce players fighting the battle. Flipkart, Snapdeal, Amazon, all of these are highly funded by various really large and great investors. And so these guys are fighting the battle for all the standardized goods. So if you're selling something which is even close to what they're doing, I agree, it might get a little hard for you to receive venture capital funding, because at the end of the day, no one wants to enter that fight now. But if you can, so differentiate yourself with a product pricing, with any additional services, something that Flipkart will or a Snapdeal that they will not enter into, or if you have a strong unique point over there, then I don't see a reason why anyone would not want to invest. E-commerce still continues to be one of the key investment areas, be it various marketplace models, vertical marketplace. We ourselves have invested in a great company there with Pepperfry, and they have built such a defendable business compared to horizontal players like Flipkart or Snapdeal or Amazon, that I mean, if that's a given, then there's no reason to not invest.
Perfect. And last question, Stefan, it's an interesting question, is would you advise startups to hire a consultant to help them with valuation? Because most of them do not have any idea how to go about valuation and negotiate and where to start, is the question that Faninder has.
So I don't know, hire a consultant for an early stage startup. See, I think if you get into the network of the startup scene, you will probably get better insights into how the valuation process works than any consultant can give you. I think that's probably also the best advice that you can get. Just engage with the entire startup community. You will get a lot of learnings from there, not only on valuations, but other things as well. Operationally, how have other people done various things that you might be going through? So I think that this should be a better learning for any topic than hiring consultants. But yeah, I mean, as your company grows bigger, as you might raise larger fundraisers, hiring consultants, investment bankers specifically for raising funds might not be the worst idea, as it otherwise might distract you from your core business. But in the early stage phases, I think just engaging with the entire startup community might give you really great advice in any matter.
Perfect. I think that's great advice. And on that note, thanks a lot, Stefan, for your patience and taking all the questions. I know we're late by 5 minutes, but thanks a lot for your patience. I know there are a lot of questions that we have not answered because there is limited time, but what we will definitely do is we will collate these questions and try and see if Stefan can answer some of them over the email, and we can post it back on the channel that we're currently using. And finally, also a lot of questions around can the PPT that Stefan has used be shared for our reference? And I think we'll be able to do that as well, and you will receive it. So again, thanks a lot for all the participants who have spent time in this Hangout session. And Stefan, again, a big thank you for this brilliant session on funding and the current VC landscape in India.
Thanks a lot for having me.
Perfect. Thank you so much, and good night, everybody.
Thank you. Good night.
Bye.